Now let's talk about variable rates. This is the second video all about variable rates. I love this because with this information you will know more than most people know about both fixed and variable rates, and you will be able to make better decisions for your own home or rental investment properties. So let's dive into this. What we're gonna see and learn here. First, how variable rates work. Second one, who sets the variable rates, the pros and the cons of variable rates, and then we'll wrap up with a nice summary so you can remember the key points about this presentation. Now, how variable rates work. A variable rate mortgage charges a set interest rate that changes during the term of your mortgage. So when you have a mortgage, you have a term, which we discussed in the previous video, and that term, the interest rate can change over time, okay? Now, during that term, the payment will change, and also during the amortization of your mortgage, the payment will change and the interest rate can change, okay? Now, the variable interest rates will be set according to a discount over the prime rate of Canada, okay? So as an example, the bank will give you a discount, let's say half a point or 0.5% below prime, okay? That discount does not change over the term. The only thing that can change is the prime rate. So once you have your discount, that doesn't change. The only thing that changes is the prime rate of Canada. So that's how variable rates work. Now, the prime rate of a bank follows the prime rate of the Bank of Canada. What this means is that variable rates are managed by the government of Canada, by the Bank of Canada, the central bank, okay? So it's a very thoughtful process and a very secure process because it's not left out in the wild in the markets. It's basically a government decision based on the well-being of the economy and the people, okay? Now, this is super important. You may know this or may not, but there are two types of variable rates. The first type of variable rates is one with a variable payment. So as the prime rate changes over time, the payment could go up or down. And the second one, it's a variable rate with a fixed payment. So the payment will not change, but if the interest rate changes, what that means is within that payment, you're paying a little bit more interest or a little bit less interest, which means less interest will mean more principal, okay? So that second type of variable rate is very good for people who are a little bit uneasy of changing their mortgage payment. If they want a fixed payment, that rate will be very good, that variable rate with a fixed payment. The only exception to that variable rate with a fixed payment is if the interest rate increase enough so you do not pay the interest. The bank will increase your payment if the payment is not enough to pay the interest. But I don't think that has ever happened since that product was created, because in today's environment on a 25-year amortization with the current rates, about half and half are paid to principal and interest. It depends, of course, but that very seldom happens, okay? So remember this, there's a variable rate with variable payment and there's a variable rate with a fixed payment. Now, common terms for variable rates, 5 years is what most people take, but there's also other terms for variable rates. You can take a 3 and a 5-year term, and you can also change your term at renewal. So, for example, let's say you started on a 25-year mortgage or 25-year amortization. Your first term or 5 years can be in a variable rate. Then you can choose a 10-year fixed rate, and then at the next renewal, you can go back to a 5-year fixed rate, and then in the last 5 years of your mortgage, you can go to a 3-year variable rate and a 2-year fixed rate. So this is very flexible, okay? You can go back and forth within your renewal dates, okay? This is also very important. You can switch from a variable rate to a fixed rate without any penalty. There's no cost, and the only exception is that very few lenders will not allow you to do that. But most lenders, most banks and credit unions, and most lenders will allow you to switch from a variable rate to a fixed rate. And the way it usually works is, let's say you started with a 5-year variable rate, and let's say 2 years go by, so you have 3 years left on your initial term, and you want to fix the rate, okay? Usually the bank will offer you a brand new 5-year fixed term, but because you have 3 years left on your mortgage, you could actually choose a 3-year term or a 4-year term, okay? So again, you can choose a term higher or bigger than whatever is left on your mortgage, okay? And that should be at no cost to you. You just take the fixed term that you have at that moment that you want to fix your mortgage. Now, if you want to do the opposite, if you want to switch from a fixed term to a variable rate, you have to pay the penalty. And as we saw in the previous video, penalties on fixed rate are very, very high. And they are designed sometimes in a way that if you want to achieve some savings, the penalty will basically offset those savings. So if you switch from a fixed to a variable, in a lot of situations, you don't have any benefit, okay? But in any case, it's worth doing the math. And if you have questions on this and you have a fixed rate and you want to change to a variable, because you right now see that there's a lot of savings on variable rates, we can do the math and see if it's worthwhile. Now, another important thing, there's some variable rates that have an interest rate cap. What that means is that by contract, the rate cannot be higher than a certain amount. I'll give you an example. You have a variable rate. Let's say right now your variable rate is at 3%, and you have a rate cap of 5%. What that means is even if interest rates continue to go up, the maximum that lender will be able to charge you is 5%, even if the rates go to 6 or 7%, which is very unlikely, but that is another type of variable rate. It is not very common because when a lender offers that guaranteed, they don't give as much of a discount below the prime rate. So if you have, let's say right now you can get a regular variable rate at 2%. One with a rate cap could be probably at 2.3 or 2.5%. So they charge a premium for giving you that guarantee, okay? In most cases, it's not worth it, but if you want more information, feel free to contact our office and we'll be super happy to give you more examples. Okay, so these 3 points are also very important. Penalties on variable rates are only 3-month interest. That is very different than the fixed rate, which is the highest of the 3-month interest and the interest rate differential. So as an example, on a $400,000 mortgage and a variable rate of 2.5, the penalty could be about $2,500. If this was on a fixed rate, it could be 3, 4, and sometimes up to 5 times that amount. So there's a big difference between the penalties on variable rates and fixed rate mortgage. And again, there is no IRD, interest rate differential, on a variable rate. There's very few exceptions. You have to read the contract. You have to work with someone that you trust as a mortgage broker that you trust, because there are some variable rate contracts that may have different clauses than this that I'm showing you in this video, okay? Of course, with our offices, there's always full disclosure, but sometimes some lenders will offer you a super discounted variable rate, which is very appealing, but the penalty structure may be different. So you have to be careful. You have to read the fine print or ask for the fine print. But in most cases, the variable rates have only 3 months interest penalty. Okay, so let's go to the second part. Who sets the variable rates? Variable rates are set by the Bank of Canada via the prime rate. So it is the government and a bunch of PhD in economics and people that are super clever that sets the interest rates for the whole country. Okay, so what I want to say is that this is not something that the government takes lightly. This is super, super important for the government and for the well-being of their citizens. Okay. Now, banks have their own prime rates, but they all follow the Bank of Canada prime rate. Okay, they have their own prime rates, but they follow the Bank of Canada. There are very few exceptions where the prime rate of a bank is not the same as the Bank of Canada. So some major lenders make that confusion, and it confuses everybody. But at the end of the day, the net rates may be almost the same. Okay. Now, the prime rate does not move up and down like a stock. It's not even close. A stock moves up and down every hour, every couple of hours. The prime rate is totally different. It's very, very stable. Okay. So the Bank of Canada meets only 8 times a year to review the prime rate. So again, as I said, there are hundreds of PhDs and economists that review this. They review the economy and they decide if they move it up and down. In most of the cases, they leave it the way it is. And sometimes when they need to move it up or down to influence monetary policy, they would do it by a quarter of a point. So 0.25%. Okay, that's usually what they do. In extreme cases, they will increase it by half a point, but that's again very, very rare. On the contrary, when there is a big economic issue like we had with COVID a few years back, they have the ability to reduce it really quickly. So within a few months, I think they reduced during COVID, sometimes like 1% or even higher, because they wanted to help the economy. Okay, have in mind, some people think that because the world is very crazy and they feel unsafe with variable rates, when something wrong happens, what the government do is lower the rate to help homeowners and the people, right? So only when the economy is in full cylinders and everything is working really well and all the industries are going really well and that creates inflation, then interest rates go up. But they don't go up indefinitely. They go up a little bit, then they stable and they come down, and they keep going up and down for years and years. Now that we're talking about the prime rate, this is the graph of the history of the prime rate of Canada since for the last 20 years, since 2000. Okay, most people who are afraid of variable rates, in my experience, because I've been doing this for 20 years already, in my experience is because they come from countries where they've seen that their own governments have not use their monetary policy in the right way. So they've seen hyperinflation and inflation that is really, really high, and fluctuation on mortgage rates that are not what we have here in Canada. Okay, so that's one type of people that they have seen hyperinflation in third world countries or other countries that is not as stable as Canada. The second type of people that are very scared about interest rates is people who lived here in Canada in the 80s. In the 80s, interest rate in Canada, mortgage rates went through a pike up to 18% for a year or so. Okay, and of course, people got super worried because if they lived through that, they saw people lose their homes because of interest rates going super high. What I have to say about that is the following: nobody knows the future, but also relying too much on the past, it may be a mistake. In my humble opinion, and again, full disclosure, I'm not an economist. I am, and I love to study and read books about economy and monetary and fiscal policy, and I read a lot of blogs and information about the economy in Canada and the world, but I'm not an economist, okay? But in my opinion, the world has changed very much since the 80s in Canada, okay? Only in the last 20 years, when I started doing mortgages 20 years ago, the total amount of mortgages in Canada was 600 billion. Now, 20 years later, it's 1.8 trillion. So 3 times. For me, that's amazing. So from the history, from day zero in Canada up to 2003, more or less, it took hundreds of years to get to 600 billion. And then in the next 20 years, 2 times that amount. So we added 1.2 billion to get to 1.8 trillion in total mortgages in Canada. 1.8 trillion. So 3 times. So it's a huge rock. Moving rates on so much money is very difficult. It becomes really heavy, and it moves too many levers in the economy. So the central bank is very careful on using interest rate to move the market. I've seen countries like Japan or countries like Switzerland, a lot of European countries, and some Asian countries that have similar developed economies like Canada stay with low rates for decades and decades because they cannot increase them too much because it slows down the economy. The moment the economy starts to slow down, they drop the rates and they keep low rates forever. In my humble opinion, and again, full disclosure, this is just my opinion, mortgage rates in Canada for the foreseeable future will be low almost forever, because if today we have 1.8 trillion in mortgages, can you imagine in the next 10 years? I don't want to even say how much mortgages we're going to have in the next 10 and 20 years. And then the more money you have lent on real estate, the easier easier it is to keep them low, and the more difficult it is to increase it, because the more you increase rates, the more you affect all the other industries. Okay, so that's my 2 cents on interest rates. And you can see right now the graph of what we have been in the last 20 years. Now, another common fear: if interest rates double, my payment will double. So I just did a quick example here on a $400,000 mortgage at 30 years amortization. So if you have an interest rate of 2%, your payment is $1,693. If you go to 3%, your payment is $1,893. If you go to 4%, it's $2,104, and 5%, $2,326. So if you see, when you go from 2% to 4%, it increases by $400. Okay, so that's roughly the math. Of course, with different balances, you'll have different numbers, but that's just to show you that if interest rate increase a little bit, it's not a big deal. Most likely you will be able to afford it, because at the approval process, the government, through the stress test, tested you that you could afford going into a variable rate. Okay, now what are the positives or the pros of variable rates? Okay, over the term of your mortgage, borrowers have paid less in variable rate versus fixed rate, and that's over the last 20 years. Okay, in my opinion, in the future, this is most likely to happen again. Okay, now penalties for switching lenders or to allow for changes are low. So when you take a variable rate, if something happens in the future and you need to rearrange the mortgage, redo it, transfer it to another lender, sell your home, you will not be hit with a big penalty that is going to ruin your day or your year. Okay, so this is a very good, important decision when you're taking a variable rate. In my opinion, again, the future looks promising for variable rates. You may see the year that I recorded this video, which is 2022, that everybody is thinking that the sky is going to fall apart because interest rates are going to start to increase a little bit because there's a lot of speculation on inflation. Oh yeah, rates can go up, but they're not going to go up forever. They'll come down. And because I know about what's going on in other countries, and I know about the increasing amount of lending that there is in Canada, my humble opinion is that rates, if they go up, they will come down again, and they will remain low for very, very many years or decades into the future. So in my opinion, future looks promising for long term for variable rates. And last one is very, very important. You can choose a variable rate with a variable payment, which is the standard variable rate that everybody is used to, but you can also choose a variable rate with a fixed payment. This second one is very good, for example, for rental properties, because you set your rent and you set your mortgage, and even though if it's a variable rate, the payment does not change. And also for people who feel a little bit insecure about going full term on a variable rate. Okay, that's something that I would recommend as well. And remember, you can also do half and half, or 60% fixed and 40% variable. So if you have, for example, a $500,000 mortgage and you don't want to go all in on a variable rate, you still have your doubts or you feel unease, you can ask our office to set up your mortgage. Let's say for 300,000, we would be on a fixed rate with fixed payment, and 200,000 it could go on a variable rate with variable payment, or on a variable rate with a fixed payment. So that's a huge benefit of having options and working with a broker. What are the negatives of variable rates, or the cons? Of course, it brings uncertainty to rates over the term of your mortgage, and that's the main one. People don't feel secure if you know that the interest rate can move up and down. We discussed, this is done very slowly. It's done only 8 times a year. You can Google dates when the central bank changed the prime rate and the year, and it will give you the exact dates, so you are ahead of the news. When you start receiving the news that the rates are gonna change, you already know, because you know when the dates are going to be. So that also gives you some certainty on your variable rate mortgage. The second con is that you can get influenced a lot by media or banks stressing people over rate hikes. I've seen a lot banks harass their own customers to change from variable to fixed, and they give a lot of reports and a lot of calls to people, advising them to switch into a fixed rate, and then later rates go down, and now they're not calling anybody because they know that they are better at a higher rate with a fixed rate. So just be careful about who you get your information from. Banks, they have a vested interest in you doing something. Okay, media also, they will print whatever people read, not necessarily whatever is best for people. Okay, and sometimes I've seen people get advice from other people that have no idea what they're talking about. So you have to get your source of information from the right person. And last one, I put this in red. You may see that this is the only thing that I have read in this whole presentation. If you fix your variable rate when rates are going up, you may end up paying higher mortgage interest rates over the term of the mortgage. The only thing that I do not recommend to anybody is the following strategy. Camilo, I am going to take a variable rate, and when interest rates start to increase, I will fix my rate. In my opinion, I've seen people do that over the last 20 years. I don't see anybody being better off when they do that. And I'll tell you why. When variable rates are going to start to increase, don't ask me why, but I've seen fixed rates go up first. So before the variable rates go up, fixed rates go up. Why? I don't know, but I've seen this over and over again. So when you are in a variable rate and your rates start to increase and you want to switch to a fixed rate, fixed rates are already up and you end up paying way more money than you should do, than you should. It's better just to wait, be tight, don't listen to the media, and wait a little bit, because rates go up a little bit, they may go up a little bit more, and then they will stay the same, and then they will come down, okay? And stay in your variable rate. I do not recommend switching from variable to fixed when variable rates are going up. I actually would recommend, I would consider fixing a variable rate when the fixed rates are going down. So if you see, for example, that you have a variable rate, let's say at 3%, the fixed rates are at 4%, for some reason fixed rates start to become from 4 to 3.5 and maybe 3.1. Oh, perfect timing. There's not much difference from 3.5 to from 3 to 3.1 to switch. You can switch the same rate and you have certainty, but that very seldom happens. Anyways, read this in red. If you fix your variable rate when rates are going up, you may end up paying higher mortgage interest rates over the term of your mortgage. Summary, I'm just wrapping up. Pros of a variable rate: lower cost of ownership and flexibility. Lower cost of ownership over the long term and flexibility. If anything changes, you are secure because you can get out and you are not going to be hit with a big penalty. Negatives: uncertainty of the rates during your term. Okay, that's of course the big negative. Be aware, as I said before, where are you getting your information from? Is it media? Okay, so media has no indication about your personal situation. They just wanna print information that people read, which is usually fear-based. Second one, banks. Remember, banks are in the business of making money. They're not in the business of advising people to increase their net worth. They're in the business of making money. So just be aware when you get information directly from your lender, okay? It's better to have an independent mortgage broker help you out and give you independent advice that he's not linked to any bank directly. And most important, do your numbers. You will love the next video. In the next video, I'm gonna go and dive into numbers so you can analyze very easily when to go from fixed to variable or variable to fixed and win on the mortgage game. Thank you very much. Camilo Rodriguez with Mortgages Lab. See you in the next video.